What would happen if millions of people suddenly decided to buy the exact same ETF? Ethan thinks the answer is obvious. It would explode. If everyone is buying it, the price has to go up. Ryan isn't convinced. Okay, but where does all that money actually go? Oliver looks at both of them. That's the interesting part. The ETF isn't just a giant box where everyone's money sits. So let's say this ETF tracks 500 companies. Ethan puts in $1,000, Ryan puts in $1,000, Oliver puts in $1,000. Now imagine millions of other investors doing the same thing. Suddenly billions of dollars are flowing into the same ETF. Sounds crazy, right? So what happens? Does the ETF just collect all that cash? No. An ETF is built to hold a portfolio of assets according to its rules. When new ETF shares are created to meet investor demand, the fund structure can use incoming money to buy the underlying stocks that the ETF is designed to track. So if the ETF tracks 500 companies, the money can ultimately be used to buy pieces of those companies. Ethan looks at the screen. So if everyone buys the ETF, they're basically buying all 500 stocks. Pretty much, but not necessarily in equal amounts. And here's where things get really important. The ETF doesn't magically make those companies more valuable just because more people bought the ETF. Think of it like a giant shopping basket. The ETF is the basket. Inside are hundreds of different products. Buying more baskets doesn't automatically make every product inside worth more. The value still comes from what's inside the basket, so if millions of people want the ETF, there can be huge demand for it. That demand can affect the market, but the ETF isn't a money printer, and this is where Ethan's original idea starts falling apart. Wait, so everyone buying it doesn't mean the ETF can just keep going up forever? Exactly, because now we have to ask the much more interesting question. What happens when everyone wants to sell it? And that's where this story gets a lot more serious. Now imagine the ETF becomes insanely popular. Millions of people are buying it every week. Ethan sees the number of investors growing and gets excited. See, more people are buying. This thing is unstoppable. Ryan isn't celebrating yet. He asks the question that actually matters. Are they buying because the companies are becoming more valuable or because everyone else is buying? That's a huge difference. Imagine the ETF holds 500 companies. If people buy the ETF, the fund may need to buy more of those underlying stocks to keep the portfolio in line with its rules. So there can be real buying pressure on the companies inside the ETF. But here's the catch. Those companies still have to justify their value. Imagine one of the companies inside the ETF makes $10 billion a year. If investors suddenly become convinced that the company will make much more money in the future, they may be willing to pay more for it. That makes sense. But what if nothing about the business changes? The company still makes the same money. Its products haven't improved. Its profits haven't grown. Yet everyone suddenly wants the stock because the ETF is popular. Now you're getting something very different. You're getting more demand without the same increase in the underlying business. Oliver explains it with a simple analogy. Imagine a concert with 10,000 seats. The concert doesn't become better because 100,000 people suddenly want tickets. The seats are still the same seats, but when demand massively exceeds supply, people may be willing to pay much more to get one. The same basic idea can affect financial markets, and this is where Ethan starts to understand why popularity can become dangerous. He originally thought, everyone buying the ETF means everyone is getting richer. But that's not how it works. Someone buying at a higher price isn't automatically creating new wealth. They're buying an asset from someone else at that price. And if the price has been pushed higher, mainly because investors are willing to pay more, eventually the market has to answer one uncomfortable question. What happens if people stop being willing to pay more? Ryan looks at Ethan. Okay, so if everyone keeps buying, things can keep moving up. But what happens when that stops? Oliver nods. Now we're getting to the real problem. Because buying is only half of the story. Now flip the whole situation around. Instead of millions of people buying the ETF, imagine millions of people suddenly want to sell it. Ethan sees the price dropping and panics. Everyone's selling. Get me out. Ryan looks at the screen. Wait, if everyone is trying to sell at the same time, who is buying? And that is the right question, because an ETF doesn't just disappear when investors sell. There are still underlying stocks inside the fund. But when huge numbers of investors want to exit at once, the market has to find buyers willing to take the other side. If buyers are still there, trades can happen. If buyers demand a lower price, the ETF's market price can fall. And if the underlying stocks are falling too, the ETF can fall with them. Oliver explains it with a simple analogy. Imagine a stadium with 50,000 people trying to leave through one door. The door still works. It hasn't vanished. But if everyone pushes toward it at the exact same time, things get messy. Financial markets are more complex than a stadium, but the basic idea is useful. A market needs buyers and sellers to trade. Ethan looks worried. So can an ETF just become impossible to sell? Not normally just because lots of people want out. That's an important distinction. A large, widely traded ETF can have mechanisms that help keep its market price close to the value of the assets it holds. Specialized market participants can create and redeem ETF shares, and they can trade the underlying securities. That helps keep the ETF from simply floating wildly away from the value of what's inside it. But that doesn't mean you're protected from a market crash. If the companies inside the ETF are losing value, the ETF can lose value too. And that's the part Ethan finally gets. He thought the ETF itself was the thing creating the value. It isn't. The ETF is a structure that gives investors access to the underlying assets. If those assets rise in value, the ETF can rise. If those assets fall, the ETF can fall. So if millions of people buy the same ETF, that doesn't create some endless money machine. And if millions sell it, the ETF doesn't magically become worthless. The real question is always, what does this ETF actually own, and what are those assets worth? Ryan nods. So the scary part isn't that everyone owns the same ETF. Right, Oliver says. The real question is whether everyone is taking the same kind of risk without realizing it. So after all that, what's the actual answer? Would it be bad if millions of people bought the same ETF? Not necessarily. An ETF becoming popular does not automatically make it dangerous, and millions of people buying one ETF does not mean the ETF suddenly becomes a giant bubble that has to explode. The important question is much simpler. What does the ETF actually own? If Ethan buys an ETF that tracks hundreds of companies across a broad market, he is spreading his money across those companies instead of betting everything on one business. If Oliver buys a narrow ETF that focuses on one tiny industry, he could still be taking a much bigger risk, even though the word ETF is printed on the screen. That's the part people miss. ETF doesn't automatically mean diversified, it's just a structure. You still have to look inside. Ryan now has a simple checklist. Before buying an ETF, he asks, what does it track? What does it actually own? How concentrated is it? What does it cost? And most importantly, does this match the risk I'm actually willing to take? Because the original question sounded scary. What if everyone buys the same ETF? But the answer isn't the ETF breaks. The answer is, it depends on what's inside and why people are buying it. If millions of investors buy a broad ETF, they're still ultimately buying exposure to the companies or assets inside that fund. If those assets become more valuable, the ETF can benefit. If those assets fall, the ETF can fall too. And if everyone starts buying simply because everyone else is buying, that's when you should stop and think, because popularity isn't proof of value. Ethan started this story thinking, if everyone buys it, it must be safe. Now he knows that's not enough. Ryan thought the ETF might somehow run out of room if too many people bought it. Now he understands that the fund structure is designed to handle investors buying and selling. And Oliver knew the most important question from the beginning: what's actually inside? That's the question you should take away. Don't buy an ETF because it's popular. Don't avoid an ETF just because millions of other people own it. Look through the label, because an ETF is only the basket. What matters is what's inside the basket.